Good morning. All right, so I'm Wong. So I have been talking with different group of people, right? So I talk to politicians, I talk to government officers, I certainly talk to my students, my peers. I go on TV and radio. The only group of people that I never talk to will be the investors community, right? I never talk to investors, stock investors. I never know that kind of, whenever you hear, of course, your aim is to like find some good tips to earn money. So for that, I surrender myself, and I have to like be frank at the very first place that in the next like 30 minutes, I have no tips for you, right? I won't be able to tell you, what stocks to buy, but I'm here to share you three different things about the global, the world economy, the economy that we are facing, right? So the first part, I will bring you to the global economy, right? To take a look on what is going on in the global economy, all right, and what are the problems that we are going to face or already are facing at this moment. So after that, we will turn back our attention to Malaysia, right? See where we are today, because we still have 4.9% growth rate last quarter, which was very good, right? Given whatever happened in Singapore and South Korea, then you'll notice that 4.9% was exceptional. All right, but is that the something good that we can cheer for the next quarter or next year? So we will talk about that in the next session. The last one, of course, we will bring back our attention to the policy making. So are we ready to face another downturn if it came? So that will be the three parts that we will talk about today. All right, so if you look at the title, Another Goldilocks Economy, then you already know my conclusion on where we are today. So when we use the word Goldilocks economy, that basically means the economy at this moment is neither too hot nor too cold. Because if I'm telling you that we are already in downturn, stupid, we have 4.9% growth rate last quarter. Am I right? If I'm telling you that we are doing very well, then people will say that you are bullshit economists. How can you say that we are doing very well? Everyone feel the slowdown. So we are exactly at that kind of situation, neither too hot nor too cold. We are not yet having crisis, but we are not doing very well. So that will be where we are today. And because of that, we have to beware of the bears. So therefore, the presentation will be more on bears. Where are the bears? The bears that may crush things, all right? May make things worse or may make things better. So look at the bears. All right, so this will be outlined. So let's start with the first part on the global economy. Then all my presentation today will be on figures, all the figures that I have compiled, rearranged, and I'll try to present to you what conclusion we can make. And my conclusion will be on the title. So you may not need to go to the details what it is. You don't need to. You just need to look at that pattern. And the pattern, you'll notice that they are very synchronized, they are very clear, across different scenarios. So what do you mean by this? You look at these charts. This is about the trade between China and United States. So we call it bilateral because it's just between China and United States. All right? Then you will notice that there are actually a very clear pattern before and after. Can I use the pointer? No. So it is before and after. What do you mean by see before? You look at the left-hand side of this diagram, they are mostly bars above. All right, so that means they have a positive growth of the trade between China and the United States. But then you will notice that after certain periods, they are basically all downside bars. The spike go downward. So that means you have a negative growth rate. And where is the cutting point? The cutting point is exactly last year, October, November. So if you do remember the history or the episodes of the China, what they call the China-US trade war, it actually started in March last year. That was the first imposition of tariff on Chinese exports of $50 billion to United States. But no one paid attention by then because they believe that this is just another easy game to win for United States. That the Chinese will easily bound to United States and agree whatever the US wanted them to do. So in fact, by then, if you do remember that just now, Mr. Derek showed you, the New York Stock Exchange, the S&P 500, the Dow Jones, U.S. stock markets rallied after the trade war because they believe that the US will win the game again at the end. But by then, when it comes to September, second round of tariff on 250 billions of Chinese export to the United States, then people start to worry. Markets start to worry. Why? Because number one, they notice that it is not an easy game to win. Number two, that imposition on tariff 250 billions, they are mostly on what we call intermediate inputs, those parts and components, those chips, those that semiconductors. And those are the inputs at the same time being exported by other countries in this region, Malaysia, South Korea, Japan, Taiwan, for instance. And because of that, you'll notice that these second charts, what are them? They are the trade of China with the rest of the world on the left-hand side, and the trade of United States with the rest of the world. So we are no longer looking at the impact of a trade war between China and the United States, but we're looking at the impact of trade war on the rest of the world. And again, you notice a very similar pattern, am I right? This diagram on the US, again, you will notice they are very, very clear before and after. Before that, they are all positive bars above. Then suddenly, the bar squeeze or even turn negative. Same case goes to the case of China. On the left-hand side, they are mostly, again, a positive bar above. Then after a certain point of time, they start to disappear. They either become zero or turn negative. Again, what are the cutting point of the date? Last year, October, November. So that tariff war really start to bring problems not just to China and United States, as we saw in the first charts, but to the rest of the world as well. All right? And because of that, then you start to notice that it's not just about trade. That if it is only about trade, then in fact, the impact will be very minimal. Because trade for China and United States, even though they are open, they are huge, but the importance of trade to their economy, in fact, are not huge. All right? But you start to notice that impact of trade spilled over to other things. For example, on the purchase of the materials. So this is a very popular index to be used to show whether the economy is healthy or not. What is this? This is PMI. Again, I have China and United States. The red color refers to the China PMI index, and then the blue dot color refers to US. So what is PMI? It's a purchasing manager index. So that basically tells a very simple story. If the economy is doing very well, sales orders are there, customers just are there waiting to buy your products, then of course, as a businessman, then you certainly will buy more materials, am I right? Because you need materials to produce and then to meet the customer's need. So that means, in order to understand what happened in the market, you just look at the activity on purchasing the materials. What happened then? Again, you'll notice that before a certain period, they are mostly running sideways, right? That means they are still okay, and then suddenly they just slopes downward. Again, what is the cutting point of the date? October, November last year. All right, so that shows that the trade war started to have impact spill over to other sectors on investments, which we'll see later on, as well as on the manufacturing activities. And one more point before we proceed. You look at the case of the red color. Even before the trade war, the manufacturing activity in China already started to slow down. Right? That is partly because of the effort to deleverage the Chinese economy, but plus other issues. So trade war only amplified the weaknesses within the Chinese economy. So what is this about? So I plot the industrial production. So that basically means manufacturing activities in all these countries. Where I put US, China, Europe, Germany, Japan, Korea, and Singapore. Again, you just read from left to right. You'll notice that line, all the lines basically, they just slope downwards, and some of them, they're already at the negative territory. So that means they started to shrink. The manufacturing started to contract. That's a bad sign, right? We can go further and further. This is what? This is the Fdi outflows. This is the foreign direct investment flowing out from these major economies to the rest of the world. And what do we see? Again, is that kind of downward sloping growth rate. So that means their incentive, their motivation to go out to invest in other countries getting smaller and smaller and smaller. And you know the impact to the rest of the world. That means all other economies like us in Malaysia, our ability to attract FDI getting smaller and smaller. So that, again, is another indicator of the problems that we have in the world economy. So when we turn our attention to financial markets, so this is what we are, what we have. What is this? This tells you the return on the government bonds, the 10-year government bonds. I took the case of Germany, Japan, and United States. Two lessons from this diagram. Number one, again, you'll notice that very clearly. Look at the blue dotted line. Initially, before some dates, they are just like moving, stable line. And then after certain dates, they start to slow down. Am I right? You look at the bars, the red color refers to the Germany 10-year treasury bonds. Initially, they are on the left-hand side, they are all positive. Then after certain periods, they start to getting smaller and smaller and turn negative. Same case goes to Japan. And again, the date will be the October, November last year. So when you have that slowing down or going down interest rates on the 10-year government bonds or even turn negative, like what Mr. Derek had mentioned just now, negative yield, what do you mean by that? That basically means that the market feared about what's going to happen in the future. They need to park their money in safe market, in financial instruments which they deem as safe. Safe in the sense that when they put $1 into it, at the end they can get back $1 without the fear of losing the value of their investment. So in that sense, we call it safe assets. All right, so they just don't care that even if the return will turn negative, they still buy it. They still have the appetite to buy the bonds even though the bonds pay negative interest rate, for a very simple reason. When the interest rate go negative, the bond prices will go up. So in terms of capital gain, they can still get it. But of course, the main reason is that no other places are safer than bonds market at this moment, even though they give negative yield. So you can imagine how fearful the market is at this moment. All right, so this is the currencies for all different major currencies in this region. So you can just simply pick. When we say that ringgit depreciates, it's just not about the problems in ringgit alone, but basically you can observe any regional currencies, they all will have showing depreciation. So again, this is, I just took Korean won, Japanese yen, yuan, Taiwan, Taipei, Thai baht, Australia dollar. Then I took like 2018 January as the starting point. You'll notice that the line just get downward. That means all this currency depreciate against the US dollars. So we are talking about not the problems in one country, single country, but basically the whole region. You observe a capital flowing out from this region back to the United States. All right. So why this round when we keep saying that because I'm not an investor, so I don't have the burden to cheer you up, saying that next year will be another bullish year, go and buy stocks. I don't have to do that. I can play blackface to warn you that be careful. Why we need to be careful? Because if something really if something bad really happen, it will be really, really bad. What do you mean by really bad? In 1985, 86, by the time when Malaysia experienced our first recession after the independence, the rest of the world was doing very well. Japan was the second largest economy of the world, chasing after the United States. Even with this Plaza Accord, yen appreciates hugely after that. What happened then? You have all these Japanese manufacturers relocate their facilities to the south, to Malaysia, to Indonesia, to Thailand, right? Followed by South Korea and Taiwan in early 1990s. So by then we are benefited, so we rebound and we enter our best 1990s. Am I right? Then we have 1997, 1998 Asian financial crisis. We were badly hit together with South Korea, Thailand, Indonesia. But the rest of the world was doing very well. US was doing very well, heading toward their dot-com bubble. Chinese, of course, was doing very well by then, right? So then after a year of negative 6.8% recession, and then the next year we bounced back. 2007, 2008, the Great Recession. Am I right? The global financial crisis. US being hit the hardest, followed by the Europe. But China economy was doing well. The emerging markets in Asia was doing well. So in that sense, the global economy, they have a balance. Some part of the world doing bad and another part of the world doing well, so they're kind of getting a balance. But this round, if you really pay attention to the news and newspapers, what do you observe? Almost every corner of this world, they are having trouble. United States showing sign of weaknesses. Then you go to the south of the US, that will be Latin America, so you know the story of Argentina. You cross the Atlantic, you go to Europe, then you notice that even Germany, the biggest economy in Europe, doing very well even during the European debt crisis, started to show sign of recession. All right, and then you move back to Asia, so you see the problems in Australia. More than a decade without any recession, they also start to show sign of weakness. Not to speak South Korea, not to speak Japan, not to speak Singapore. Then even the Chinese economy has its own internal domestic problems. All right? So if really something bad happened, there will be the whole global economy having all their own problems at the same time. And we have no savior, we have no white knight by then, you know? So that in that sense, it sounds very dangerous. So what is this? So this is a very famous, popular, people keep saying the inverted yield curve recently. So I'll give you a very quick idea on what it is, inverted yield curve. Inverted yield curve is a yield spread, a difference between the 10-year interest between 10-year bonds and the short term. I put here 3 months. If you look at newspapers, they sometimes like to use 2-year bonds, but I just use 3 months treasury bonds. So the idea is that because 10-year bonds, it cross longer time maturity, so because over the 10 years, many things happen, risks tend to be larger, so people will demand for higher interest rates, right, to compensate for the risk. So logically, 10-year bond interest rate will be higher than the 3 months. 3 months is very short. So the spread tend to be positive. When it turns negative means that people are even willing to accept a 10-year bond interest rate, which is lower than the 3 months ahead. Under what situation you are willing to do that? It must be because you feel very desperate. You feel that the world is full of uncertainty, so desperate, and you're willing to accept a 10-year bond with the interest rate lower than the 3 months bonds. And when it starts, you look at this, so we call this inverted yield curve, right? And you notice that there are certain periods when it turns negative, that means below zero. Once it's turned negative, and then you notice there are some gray vertical bar. What are them? There are the US recession. Only US. So here refers to US, but of course you can always imagine, once you talk about US recession, you can infer to be the global recession then. The ability of the yield curve, inverted yield curve, to predict recession, out of the 11 times of prediction, the accuracy is 100%. 11 times of prediction, 11. 100% of accuracy. It's just a matter of if this is a deep or a kind of shallow or easy, a short recession. But the accuracy is 100% correct. So we have the first inverted yield curve again in June. So if based on the past historical episodes, once the negative spread first appeared, it first flashed the signal, within the next 8 to 16 months, bad things will happen. So if the first flash this round happens in June, based on that calculation, based on that inference, that means February next year to October next year. Any time in between this period will be US probably will go into recession. If nothing happened, if let's say nothing happened means good news happen, so February to October. So I heard that Mr. Derek says that next year will be a good year, probably 2001. So in that sense, I'm different with him. So you have a different view on that. Okay, so I say that another thing that why this is fearful this time, not only because all over different corners in this global economy, they have their own problems. Another main concern is that our policymaker, all the policymakers of all these major economies, they are not prepared. The economy is not prepared. What do you mean by not prepared? economic downturn is not something to be feared about, even though it's a bad thing. Just like if I lose my job, I lose my income. Is that bad? Yeah, that's bad. But if I didn't owe anything, if I didn't borrow, I'm okay, right? Because I don't have any fixed commitment. I mean, at most I just spend little, or I use my past saving until I get a new job. But if you borrow, and you borrow a lot, without a job, you still need to service your fixed commitment every month, then that is the time when you're in trouble. All right? That's the case that we worried about. You look at these charts, what are them? They are the level of borrowing in this economy, is the one I selected, right? So when you look at the note, it refers to total credit to private non-financial sector. That means it's a total borrowing by households, by all these private companies in these economies. And then I just make a comparison. The blue color bars, they refer to 2007, that's before the global financial crisis, and today, 2018. So basically you'll notice that all these orange color bars, they are higher than the blue color. That means that in today's world, all these private sectors in these economies, their borrowing level is even higher than they were before the global financial crisis in 2007. So that means if given their level of borrowing by then, which is lower compared to today, record, already brought them into problems, what happened today? When they borrow even more? Is something bad happen? Would that crush even, more dangerous? Exactly, right? So why they realized the problems, and why in the past couple of years they tried to deleverage, but it didn't work. And what happened today is that in order to counter against the negative impact of trade war, they just reverse their policy position. They try to borrow again to move the economy. And that works probably in the short term to keep the economy grow, but it is a bad thing, right, over the years. So they are not the private market is not prepared in terms of the level of borrowing. The policymaker probably yes. In what sense? You look, this is the budget deficits of, again, all these different major economies in the world. So you notice that the longest negative bar, it happens during 2009. So that's understandable, right? Because during the recession, you need the government to move the economy, so they have to spend more than what they can collect from tax revenue. But you notice that since 2009, that deficit bar, that negative bar, start to shrink. So that means they try to reduce the deficit when the economy start to recover. Again, that's understandable because you need that bullet. You need to keep that bullet to prepare yourself for the next crisis. So you need to shrink your deficit so that you can have larger deficit when things goes wrong. All right? But the only problem is that even the government itself, even though they shrink their deficit, but it seems like it is not fast enough. So therefore, their debt level overall for government, overall still going up, or still higher today than 10 years ago. All right, so you look at the case, for example, the first one, Japan, you look at Italy, you look at even the China, the lowest one, all showing more or less rising trend, rising pattern. Even though it seems like it has a curve because they try to deleverage somehow, but it didn't work successfully. All right, it's not fast enough, I would say. Fiscal side, budget side, they are okay, but not yet ready. Monetary side, they are even poorer in preparation. In what sense? They don't have bullet anymore. You look at the case of, this is the central bank overnight policy rates, the only interest rate that the central bank can control directly. So before 2007, they are all at a high level, 8%, 5%. Then you notice a very sharp drop. That's understandable. That's what central bank will do when you have recession, right? They reduce interest rates. And then they all reach zero level, the zero bound we call it. So over the years, they're supposed to raise the interest rate again. For, again, a very simple logic. When the economy already doing well, you should start to raise the interest rates to prepare yourself so that if anything bad thing happens, you can reduce it again. So probably you'll notice that United States, the blue dotted color, you see that rising trend. So US probably is the only was the only central, I use the word was because now they changed, they reversed their policy position. So United States was the only country will be able to, advanced economy will be able to do that, but the rest, they kept their interest rate on zero level for too long. So which means if bad things happen next year, they can't reduce the interest rates anymore. So that means they don't have bullet to shoot if enemy come. So that's another reason why we have to feel fearful about the potential downturn. So now that's basically what happened globally. So let's bring the attention back to Malaysia. I try to be quick. It's lunchtime, right? 12 o'clock. So this is what happened in Malaysia. We have 4.9% growth rate last year. Very good. Something, of course, to feel great if you look at what happens in our friends, our neighboring countries. But you know that there is a weakness in this 4.9% growth rate. What's the weakness? Basically, all different sectors in Malaysia. When we say sectors, I mean the business investments, the exports, the government, public expenditure, the development expenditures, they are all showing either negative growth rate or they are stagnant, right? Like for example, the public sector investment, the red color, it has been in negative territory. That means the government spending on projects has been shrinking all this while. It recovers a bit in last second quarter 2009. So with the hope that when we have the revival of all these mega projects, then that will go up again to become another supporting pillar of the economy. But other than that, you notice that the only supporting pillar we have is the consumer spending. But the only question is that how long can that last? Because if the rest of the sector, business investments are not doing well, exports are not doing very well, so at the end, all these bosses, they will start to consider, should I start to cut salary? Should I start to lay off workers? Should I start to freeze the hiring? That kind of sentiments will spill over to consumers, to workers, because they are workers, to have uncertainty in the future as well. Will I lose my job? My bonuses are so petty, the increment. So they, at the end, will start to slow down their spending as well. So if we do not have any other pillars to support the economy, so at the end, that 4.9% won't be sustainable. All right, so that's something to be a concern. So this is the charts on private investment. So private investments here means the money spent on buying machines, buying materials. Again, you more or less could see certain pattern before and after. So before that, you still have some positive bars. But right after that, either the blue color or the orange color bars, they are basically on the negative territory. And that happens to be September. So September could be because of the trade war. It could be because of the transition of GST to SST. Right? It could be both impact, but certainly the trade war environment is not doing good for our business investments. So we can skip this one. So you look at this trade. So as I said, business investments not doing well. Exports certainly not doing very well. You look at the performance, both exports and imports. Again, you would just look at two different pictures, before and after. Right? Before that, all positive bars. After that, all negative bars. And what is the cutting point of the dates? Again, it's October, November. So you can't say, even though trade wars certainly will benefit certain sectors, certain industries, certain companies. You can produce things to substitute what previously exported from China. But because I'm an economist, right? I look at overall impact instead of individual companies. If you look at the overall impact, it is not there. The positive impact is not there. In fact, you observe a negative impact. Right? And it is there, right? It's so obvious. Even about the FDI, you probably have heard about this news that, our finance ministers will mention that, the application of foreign direct investments to Malaysia have been shooting up in the last 2 quarters, which is true, right? If you look at the MIER, you go to the MIER website, look at their statistics, you do notice that the number of application means if you want to invest abroad, you probably may think, I want country A, B, C, D, right? You will tender your application form. So in terms of applications, we see a number shooting up. But you do remember that when you do application, A, B, C, D country, let's say all this country they offer you, at the end you only will go to one place, am I right? So that depends on which country offer you a better deal. So that means we have this number of applications shooting up. It doesn't mean that at the end they will come. So what I show you here is the actual number of FDI flowing into Malaysia, not the application, not the actual number flowing in. So again, we pay attention just to these two countries, US and China, because they are the gravity of discussion, right? So I have the 4 bars for each country covering last year, Q1, all the way to this year, Q1. So in case of United States, there are positive bars, right? The only thing that you don't see any particular obvious pattern of sudden rise in the actual FDI inflow because of this trade war. They are like normal growth rate. Even for the case of China, you look at the last, like the third, you don't even see any bar there. You come to the 5th, you even see a negative bar, they go downward. That means you don't see any increase in the Chinese FDI flowing to Malaysia. In fact, it is a contraction. They stop, or not to stop, but the inflow has been shrinking compared to the same period last year. So we are yet to see the positive impact of trade war, if there is any, right, on Malaysia in terms of FDI inflow. This is mostly, I believe, because of the purchase of Japanese company on the IHH stock that with the Kazana disposed to Japanese firms, right? So this is mostly a kind of one-time off increase in Japanese FDI inflow, and I believe that you won't see that in second quarter. So what is this? This is again about the level of borrowing. So I'm showing you, I have shown you the one in the major economies, the rest of the world, but this is the case of Malaysia. So same case, I have a blue chart, tell you what happened in 2007. So all these are the borrowing done by private sectors, by households, by companies. And my orange diamonds, that kind of dot, refers to what happened, where we are today, 2018, October. So what happened is not last year, 2018, October, right? So what do we have? All these all these orange diamond dot, they are above the blue bar. When we say above means we actually borrow more than what we were 10 years ago. So that makes us more fragile if bad things happen, right? So that's why this is more like an Achilles heel. So this is probably a better picture showing you a comparison across different countries. Look at 2008. What is this about? This is a plot against two things. One is the household debt, the borrowing by the household compared with GDP per capita, compared to their level of income. So then that trend line, the line sloping upward, that basically gives you an idea about how much you should borrow given your level of income. So you notice that Singapore is always a good student. Given their high level of income, they always borrow more, borrow less. 10 years ago, same case. 2016, same case. So even though they may go through downturn, but you won't see that kind of crisis crash in Singapore, all right? United States used to be a bad student. In 2008, you see that United States, given the level of income, they borrow more than what it's supposed to be. So then they went into crisis. 2016, they are close to the trend line. So that means in that case, they borrow according to what's supposed to be, given the level of income. All right. How about China? Borrow more. 2008, they are close to the trend line. So that's why they are okay, 2008. But 2016, they are above that line. So that, again, consistent with our story earlier, that China could be another gravity of crisis if it happens. All right. Same goes to Korea. All right. Okay, so what happened to Malaysia? We already borrow more, 2008. We borrow even more, 2016, compared to given our level of income. So that's the things that makes me worry. Okay, so this is something about stock market, right? So this is a global market outlook for stock investors. So I'm going to show you something about the stock market. Otherwise, I will be like not doing my job. All right, so what is this about? I plot three financial prices. One is the red dotted line, the US dollars against ringgit. So that tells you the value of dollar value for ringgit. And then I have the composite, so that's basically our KLCI index. And then I have the dollar value of renminbi, of yuan. All right, so, and I put them together as in 2014 M1. So I put them all together as 100. That means I put them at the same starting point. So what do you observe? Two lessons, at least from two messages from here. Number one, even though you would say that KLCI was not doing well in the past, KLCI is the black color line, but the ringgit was doing even worse. You know, same starting point, but it drops even more than the KLCI, right? So in that sense, our stock market is more resilient than our currency, number one. Number two, you'll notice that they actually move very closely. If you look at their turning point, they basically up and down make a turning point very closely to each other. Even though we never find 100% correlation, movement, but their turning point are very closely tracking each other. And where is the key driving factor? It is the dollar yuan. Because we don't expect our currency influence theirs. It must be theirs influence ours. So therefore, if you ask me that, can ringgit go back to less than 4, I would say that just look at the renminbi. If renminbi keep trending downward from 7.2, 7.3, that means if renminbi keep being weak, then never expect ringgit to come back. All right? For, again, a simple reason that like Mr. Koh has mentioned, all these regional currencies basically have anchor against renminbi, at least since 2005 July, by the time, May or July, by the time when renminbi start to depeg from US dollars, and we also depeg from US dollars, then we start to track very closely the movement in renminbi. All right, and you can expect that renminbi will keep weakening, at least will stay weakened, because that is probably one of the tools that the PBOC stands for People's Bank of China, the central bank in China, will have enhanced to help to make the Chinese economy stay against the trade war, right? Okay, so last part. This will go quick. Lesson number one. Okay, 10 minutes more, so I can do it. So first lesson about budget deficit in Malaysia. For all these years, we keep being told, or we keep hearing many news that, when we are in deficit, we'll be in trouble. 3.1% negative. That means we spend more than tax revenue. We have a negative, deficit. 3.1, 3.2 is something like, if we go up from 3.0 to 3.1, 3.2, then Malaysia will doom. We always have that kind of fear. But you should remind yourself that deficit is a norm. It's not an exception. Deficit has been older than I am. Older probably than many of you in this room. Why I say that? Because at least from 1970 onwards, you look at the black line, they always be in the negative territory. That means we are always in deficit. Probably except for 1994 until before 1997. That was because economy was doing super well by then, right? But other than that, we are basically always deficit. Are we gone? We are not gone, right? We're still where we are today. All right? So deficit is not something to be fearful, I would say. And sometimes it is needed. How to read these charts? Two things, Number one, you notice that they moved up and down more or less together, am I right? You look at the blue dotted line, we call it difference between investment and savings. That means the ability of the private sector to absorb the liquidity and run the business. So if the line is above positive, that means the business are very active. They need funds, they need liquidity, they need money more than what has been supplied to them in the market. The only period that we have that kind of very good performance in the business sector is during 1990s. That's when the deficit turns to surplus, because we don't need government to push to move the economy. We can leave it to the private sector. But other than that, you look at since 1997, the private sector, they are always on this negative area. That means funds are always more than what they can absorb. The investment activities are not huge, massive enough to keep the economy moving. So in that case, of course, the governments really have to carry out that role, all right? Because otherwise, that sales comes from whom? You know, you will only run business when you have sales, okay? So because of sales, then you try to buy more materials, and then you try to hire more workers. So with that, only then your impact will spill over to other sectors who supply you materials. It will spill over to the workers who have their salary to spend, so on and so forth. But then you imagine if the sales are not strong enough to motivate the private sector to expand, who has to create that sales? It has to be the government, right? That's why the infrastructure projects looks important, because it creates orders to buy this and that materials from us, SME, for example. And because of that, it will spill over to private sectors. So in that sense, it is needed. It is certainly needed if really, again, something goes wrong next year. All right, the only thing that probably will have a little worry is that we, Malaysia, also look like the rest of the world. We have the largest deficit in 2009. That's during the global financial crisis. But since then, the deficit has been shrinking over the years. Again, for a very simple reason that you need to do that to prepare yourself for something bad happen. All right, so that you have that bullets. The government has the bullets. But then in 2018, it took a U-turn, it enlarged again. So we are not sure whether this is a one-time off event or that U-turn continue in 2019. Because by logic, you shouldn't run huge deficit when economy at least was doing well, right? So that's the idea. But anyhow, the strongest, I would say that the strongest point in government policy, in the fiscal position, is our domestic debt. All right, let me go to this part. Like what Mr. Koh has mentioned just now, the most resilient feature of our fiscal position is our debt. It's almost 100% in ringgit. All right, our government debt in this case. I'm looking at the blue bar. The blue bar, it refers to ringgit denominated debt. It's close to 100%. So that means you no need to care or worry about the level of currency up and down. It's okay because your debt is always in ringgit. And the government revenue is always in ringgit. You do not have any mismatch between the currency. In that case, we are safe, right? That's a hard lesson we learned in 1997. One of the reasons we were brought into disaster was because of this mismatch. We borrow in US dollars, but we earn revenue in ringgit. All right, so that's the resilience we built up since 1997, 1998, all these years. And I would say we should not destroy it. Don't destroy it. Why have that words? Because we start to talk about borrowing in yen, Japanese yen, right? We have samurai bonds, 7 billion, then we think of second round. Would we have engaged in a third round, fourth round? That means we are trying to borrow more and more in yen again. Are we going back to 1980s when we have more yen? So that's the thing that the resilience we should not destroy. No, that's not the high debt. That means given the debt we have, how many percent belongs to ringgit bonds? How many percent belongs to foreign currency bonds? So that means if you, for example, you look at these blue bars, it's close to 100. It basically means all the debt that we have today, they are mainly in ringgit. Hello? That's what I'm saying. Many good, all right? And look at the orange bar, they are very short. They are most close to 10%. That means, obviously short term, right? That means 90% they are long term. When you are long-term debt, that means you do not have rollover problems. You do not need like every 3 months you have to issue new debt. 90% it belongs to long-term debt. Yeah, long-term. Okay, so, all right, so the last slide, this is. So the only things that probably will stuck us will be, we have sufficient tax revenue next year, right? So you probably already read from news that because of this tax transition, we means the government now will short of like 20 billions of tax revenue. So you know that 20 billions will be very useful when you need it. All right, so that will be where do we get this 20 billion tax revenue? So I mean, this is the calculation, the simulation I've done, given that if we continue GST compared to SST, what is the gap? right? So on average, it will be 17 billion per year, but the range is about 9 billion to 26 billion. So it's more or less tally with the market prediction, 20 billion short of revenue. So with that, then I close my presentation. Thank you very much.
Thank you, Dr. Wong, for a very fruitful session. So Dr. Wong, please remain on the stage, and we would like to open for Q&A. And I personally also understand that Dr. Wong is one of the economists in Malaysia. He is the one who prepared the research and also his view for our upcoming Malaysia Budget 2020. So if you have any question, please take this chance to ask Dr. Wong any questions. So just raise out your hands and the mic will come to you. The sir in the front. Yep.
So what will be in store for us for this coming budget? What will you have for this coming budget?
What do we have?
Yes, for us as investors.
For you as investors, I think you probably have heard from news that this budget will prepare for a potential downturn next year. All right, so then you probably will not expect a reduction in deficit. If not maintained, then it will slightly have a broader or deeper deficit. So if that means more spending, if that means more revenue to listed companies, that probably means a support to the stock market, which probably will be something good for you as a stock investors.
Second question, I think the gentleman in the red shirt. Yep. The fourth row.
Hi, I'm Joseph. So my question is, in terms of the economy, overall, in terms of recession, if there's global recession, but we are still spending on ECRL and construction, what does that impact for Malaysia in terms of economic growth?
In fact, it is exactly if downturn happen, I'm saying if downturn really happen, it is exactly the time when that kind of infrastructure spendings are needed. Because at least it creates a stable orders for our infrastructures or our projects contractor, and therefore other material suppliers. All right, and the money, of course, will come from the government, which you can safely think it will be a stable demand for the sales, for the orders. Because if you didn't have any governments of doing that part, you can imagine that during the bad time, no one wants to buy houses, for example. People at least, be very cautious about, let's say, buying houses. You don't see orders. When you don't see orders, you don't see project. You don't see project, you don't see any purchase of materials, no hiring, for example. And that chain of effect will be a bad one. But the government is not there to run any profit business, right? So it's there to create a stable orders. So let's say you run an ECRL for the next 4 years. So no matter how, that 4 years will have their orders there. Am I right? So at least it creates a kind of stable stream of income for all the project contractors, therefore stable income for components, supplier, and therefore for the relevant workers, this and that. All right? So how government can do that when in a downturn? Because you can imagine when downturn, the tax revenue will be in short. So therefore it comes from borrowing. So that's why we keep saying that borrowing capacity is important. Can you borrow when in bad times? That's the thing.
Any more questions for Dr. Wong? Here.
I'm Tam here. Your last slide talking about the revenue from the GST and SST. So there will be a shortfall by demolishing of the GST. So how government to close the gap here?
I guess you have that feeling in the last 1.5 years, right? So by the time when GST was abolished, you start to listen, you start to hear a lot of different taxes, am I right? You have soda tax, then you have this and that tax coming out. Then you start to have the feeling, you cut that tax and then you try to squeeze us from the different taxes. So I mean, that feelings is true. You need that revenue. But I believe that next year, upon the idea of at least to keep the economy growing, you will not see that kind of introductions of different new tax scheme. This is what my take on it, my guess on it. So again, how do you do that? If you do not have, you have a shortage in the revenue, but you want to keep the spending, the only way is that you have to borrow. All right, so therefore the borrowing will be another constant next year.
Another question? Sorry, the guys in the green shirt. In the green shirt, I think, guys, your turn. Yeah, his turn first. Yep.
Hi, Dr. Wong. I'm Bing Hin. You know, we were saying that the second quarter GDP is something that beyond expectation. But again, you see, when I look at those numbers, then I'm just wondering, you know, in terms of people's spending power, is still not there. And then in terms of companies' earning is also not there. So how could that kind of numbers of GDP being translated into all this? Like, you know, companies' profit doesn't grow much. People's spending power seems to be getting lesser. That's my question.
That's the tricky things. Of course, we feel that this seems like the market is not doing well, right? Which is true, right? So as I said, you know, like Mr. Koh has mentioned, the corporate earnings, they are still earned, but that earning, you know, the scope getting smaller and smaller. And then, but the fact is that consumer spending is the remaining power that we have. However weak it is the only one that we have, all right? And therefore, my question at the very beginning is that by the time I presented that 4.9% charts, can this sustain? Because with that kind of gloomy environment keeps going on, where the companies really earning less and less, then even the consumers started to feel that, already started to feel the heat that they start to squeeze their spending. That's the time when it's no longer a Goldilocks economy. It's no longer a feeling that it's not right. I mean, it's not right, but you cannot say that I fall sick already. You just don't feel comfortable. But by the time, if the consumer spending really start to slow down, that's the time when the economy will fall into sick. I mean, consumer spending as the only supporting pillar of the economy doesn't happen only in Malaysia. It is even the case in the United States, where the consumer spending, household spending, remains strong, given the fact that the business investments already slowed down. But again, the question is that how long it can sustain. Like you say, at the end, people will feel the heat and people will start to react to it.
Okay, one last question before we wrap up the session.
Dr. Wong, recently I read that some economists suggest that the government impose GST again because the revenue collected from SST is not enough for the government, or to increase the government revenue for the government to carry out their development. What do you think? Do you think GST will be imposed again? I don't think so, huh? That means they are going back on their election promises.
Let me give you that. So I cannot tell whether it will be reimposed, am I right? I don't believe that, at least for this current regime, it won't be reintroduced. So that's my stand, my understanding. But I think the problems of GST, it's about how we use that revenue of GST. So I give you two cases. You know that Singapore, by the time when they introduced GST, so upon what reason? Upon the reason to make the tax systems more efficient, not to collect tax from you. Am I right? So what did they do? By the time when they collect tax GST, they basically refund all this GST revenue back to taxpayers. So it's tax neutral. So that means you get the cash. Because of this, you know that you give them, you spend GST, that percentage, but you get the money back. So at least you won't hate GST that much. Canada, for example, I do remember that Tony Phua once mentioned in the parliament saying that, Canada, by the time when they introduced GST, right, so the government, following the election, right after the introduction of GST, the government was was being toppled and changed, as what happened in Malaysia. But what was different was that the GST was not taken away after the election. It was refined. It was combined with other tax to become a harmonized tax regime. What happened then, in order to compensate for what I call the loss because of GST to the taxpayers, they reduced the income tax. So you will start to like it, because more government collect the GST, more you can expect that the government will reduce the income tax. So I mean, at least a compensation, rather than more you collect, more you hate. Why? Because you imagine that it goes to the pocket of someone else. So it is really how you use that GST rather than because of that collection. Right? So that's my understanding on this issue.
Okay, our last question for the lady behind.
Yeah.
Yep.
Dr. Wong, as anticipated, US dollar might be going up again by Mr. Derek. Would you foresee our government may do the peg again as history repeat against the US dollar? And if so, how the economy is heading? Where is the economy heading? Thanks.
If you ask me, then I would suggest never peg again. Don't do the peg. Because why you want to do the peg? You can do the peg only when you close your economy, right? You have all this control on the capital, all this control on the foreign exchange transactions. But I would say that it is because of this restriction of this foreign exchange, of this capital flows. That's why we can never go back to 2.5, 2.4 ringgit for $1. For those who are young enough, old enough, you know what it tastes like when you have 2 ringgit, 2.1, 2.2 ringgit for $1 in the 1990s. All right? So what we was not ready by then was, because 1990s was a time when the financial liberalization, you allowed capital to cross freely across border, was just started in 1990s. Everyone was excited about that, then they don't have a clue on the potential harms. So that's why we have 1997 financial crisis, and we learned a hard lesson. So that's why, like Mr. Koh mentioned just now, given what we have today, our strong balance sheets, most of the debt was in ringgit. So even though currency is up and down, it didn't bring any harms to the economy. Of course, it will be beneficial for someone else. It will be harmful for importers, for example. But overall, it won't have any negative impact on the economy. All right. The fact that we cannot go back to a better rate is exactly because of this foreign exchange restriction. And people just don't like our stock market because of the difficulties in hedging this and that abroad. All right, so if you ask me, would we need to peg again? So I would say no, because it is very difficult. Basically, we don't have any successful peg cases in the liberalized financial world. They all ended in disaster. So in that case, I would not suggest to do that.
Okay, thank you, Dr. Wong, for your wonderful sharing. Thank you very much. Thank you.